CMHC MLI Select program. Why are we so excited about this? Why are we personally invested in this program? Very simple. It all boils down to one problem, one very, very big problem, and that's our supply issue. We have a massive, massive supply issue. You hear it on every platform, whether you're watching CP24, every news article. CMHC just came out with a report most recently saying we need 3.5 million new homes by the year 2030 just to reach some semblance of equilibrium. Excuse me. Anybody know how many homes we build per year across Canada? Ballpark?
450,000.
We built, last year, we did 240,000 homes. And that's just the data on housing starts. We don't have the data on housing completions. So we're not making a drop in the bucket. And that's a good year, okay? So who are we?
Yeah, just briefly about us. We're with Thailand Clear Realty Group, a part of Roll Up Page Your Community. We're about 1,200 agents at your community, but at Thailand Clear Realty Group, we're 25 agents producing at the top tier, 1%, top 35 under 35 for 2 consecutive years. So we know what we're doing in terms of real estate, and we want to share our insights with you in this presentation. Just a little bit about me. I've been from the public sector working at the President's Office in South Korea, and then went to trading commodities in Hong Kong and South Korea. And then I got into real estate about 5 years ago. Started doing residential, but then I found some value in commercial. And that leads us to here.
A little bit about myself. So I've been in real estate all my life, different versions of it. Parents started buying single family homes, always showed me how they kind of built their portfolio, got involved in property management with them. Went to Ryerson where I did a double major in real estate management and finance. And from there, I started working for, if anyone knows Smart Centers, the 3 little penguins, they build all the Walmart shopping centers. They're one of Canada's largest publicly traded REITs. I spent a handful of years there, before I joined my good buddy Tyler and Daniel here. And now we've grown to about 25, 30 some odd agents. So we've got a good background on commercial, pre-construction, residential. We've kind of traded in various asset classes, and we've got a good grasp on all of them.
So I want to start with this quote, a very famous quote: 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all industrial investments combined, and the wise young man or wage earner of today invests his money in real estate. And it's said by Andrew Carnegie, billionaire industrialist. If you don't know who he is, he built half of Manhattan.
So it's no secret McDonald's is not making the majority of their money selling burgers and fries, right? Everyone knows they make the majority of their money owning the real estate on which those restaurants operate and leasing it back to the restaurant owners. So same premise here. CMHC, if anyone doesn't know who they are, Canada Mortgage Housing Corporation. It's a federally backed organization, just like the CRA, right? And they have a very, very specific mandate. Their mandate is to bring more affordable and accessible housing to Canadians, right? I mentioned our huge supply issue. They're trying to make it easier for Canadians to get into the market when we have such finite supply.
So one such example would be as a buyer looking to purchase a first home, they might have not saved up enough down payment. If you want to buy with 5% down, CMHC will provide that certificate of insurance. And that's how most general Canadians know the CMHC.
So most people probably heard about this. They were in the news recently. The cap prior was if you wanted to put less than 20% down on a home, 5% on the first 500, 10% on the difference. The cap was $1 million, so $999,000. They just raised that to $1.5 million, and they increased the amortization to 30 years. So unless you've been living under a rock, most people have heard about this. And they also came out, this next one is pretty significant. In October, they came out with this new rule where they're going to insure up to 4 units, up to $2 million, with 90% loan to values on 30-year amortizations. That's huge. But that's just the tip of the iceberg, because this is still their residential arm. Most people aren't aware of the fact that they also have a commercial lending arm, which is what we're here to talk about today. So their commercial lending arm has a different mandate. Their mandate is to bring more purpose-built rental units to the market, whether it's new apartment buildings or retrofitting older apartment buildings and bringing them to market more efficient, more accessible. Those are very expensive undertakings, very expensive. So what the CMHC wants to do is they want to incentivize builders, investors, and landlords to bring this new housing to market. And they're doing so by offering incredibly attractive financing terms.
So the MLI Select program is based on three tiers of assessment. It's affordability, accessibility, and energy efficiency. And CMHC provides mortgage loan insurance for multi-unit developments, 5 or more, to allow for favorable financing options.
So the key thing to remember here is it's got to be 5 or more units. 5 or more units is generally considered commercial, right? So if you're getting commercial financing, traditionally, you're putting 25, 30% down. You're probably paying 6 to 7% interest on the A side, and you're probably getting a 25-year AM. So this CMHC MLI Select program allows you to get significantly more favorable terms, but it has to fit these 3 criteria, which we'll talk about a little bit more now.
So how does one qualify for a CMHC MLI program? It's based on point system.
So you don't have to take a photo of this. You don't want to write these down. If you literally Google CMHC MLI Select point system, this is it. All we need to understand is there are 3 categories that the points are being offered in. The first is affordability, which we'll expand on in a moment. But some points are allotted specifically to affordability. Some points are specifically allotted for energy efficient upgrades in the property, and some points for accessibility. Doesn't just mean wheelchair accessibility. It could be for people with visual impairments, any kind of accessibility. So we'll dive deeper into 3 of these, but the point that we want to get across here, if you go to the next slide for us, is we are trying to get 100 points. That's the goal. You want to find the perfect blend of those 3 elements to not only maximize profitability, but also maximize the amount of points you can get in order to get the best loan terms, which are these right here. If you can score all 100 points, you can get up to 95% loan to cost. What's loan to cost? Loan to cost is everything that it takes for you to go from a vacant piece of land to a fully built, purpose-built 6-unit building, 10-unit building, whatever it is. Everything from the land cost, servicing costs, zoning, hard costs, soft costs, consultants, everything that it takes to give you a shiny new apartment building. You can finance up to 95% of it, meaning you can buy with as little as 5% down.
A further benefit would be financing this 50 years. 50 years amortization means you're stretching up the mortgage for 50 years. Like we mentioned, average amortization is 25 to 30 on a residential side, but we're doing 50 years, which makes your monthly mortgage payments very low and allows you to cash flow positive. And that's the key. That's the reason why we're trying to hit that 100 points. If you get that 100 points, you also get what's called limited recourse. So if you buy a condominium today, you're responsible personally for that 100% of that mortgage. But as with limited recourse, you can be responsible for anywhere from 25 to 50% of the mortgage. So you're only responsible for a portion of the mortgage that you borrow in case the project is not as successful as we want it. But also, having this limited recourse protects you as a owner of the corporation.
Big thing too I want to point out here, because it's a big misconception. With my father, he's a sophisticated investor. He's always bought single unit buildings, small portfolio. He first heard this and he's 50 years amortizations. I'll be dead by then. That's not the point. The point is the name of the game in multifamily is you want to stretch out your payments as long as possible to make them as small as possible, because the name of the game is cash flow, right? And if you're financing a building almost at 100% of it, the only way that it can be cash flow positive is with a 50-year AM. So let's dive into those 3 requirements a little bit deeper. We'll start with affordability, and this is the one that we really want to drive home, because this is arguably the most important one. Big reason we are very, very bullish and very, very active on the Alberta multifamily specifically. We'll take a step back for a moment. Number one, it's because they have the highest net interprovincial migration, meaning across Canada, more people are leaving all other provinces and they're all going to Alberta. They've got the highest population growth. They've got the lowest amount of existing inventory. And this is exactly why their vacancy rates have tumbled. Their vacancy rates went from about 7% in 2021 down to under 2% today. Some pockets of Alberta have vacancy rates below the 1% mark. That's an extremely tight rental market, very, very competitive. So that's the first reason that we're bullish on Alberta. The second reason is because of this affordable requirement. Very big misconception: when people hear affordable housing, they think low-income tenants. They think welfare tenants. They think government subsidized, bad tenants. Not the case at all. It's a huge misconception. What affordable rents are is every year the CMHC comes out with a benchmark rental rate for every market, for Toronto, Calgary, Vancouver, etc. And they have a very specific formula to do this. Uses a combination of the cost of living in that market, the median income in that market, and they come up with a benchmark rental rate. So in Calgary, that rate is $1,750 a month. In Edmonton, it's $1,655 a month. The goal of affordability, in order to hit those points, is you have to offer a certain portion of your building either at or below those rental rates. So this doesn't mean this doesn't mean being a slumlord. This doesn't mean offering units that are less desirable. It means getting creative, right? Maybe parking on your other units is included, but on the affordable units, you charge them $100 a month. But more importantly, the benchmark rental rate in Alberta is higher than the market rate for the most part. So I know I can rent a bedroom apartment, a one-bedroom apartment for $1,300, $1,400 a month. That's below the $1,650 cap, meaning you're scoring points on the system, but you're not sacrificing profitability.
While we're on the topic of why Alberta, first of all, there's no development charges. In Toronto, it's incredible how much the city taxes us. Second is that there's no realtor fees. In Alberta, renters go directly to a property manager and rents it out. So that saves 1 month of leasing costs. And another topic is that Toronto has affordable rents set at $1,200 as opposed to $1,655 or $1,750. And that's why it makes sense in terms of cash flow that it makes sense to do this project in Alberta.
Very rare that you'll see these new builds in Toronto because the affordable rent is so low. Across Ontario, you're in the 1200s, meaning I have to offer a unit at or below $1,200. A studio rents for $2,000 a month here. Doesn't make sense. It only makes sense out west where the median income, or the median rent rather, is above or below market.
So we talked about the three criteria, one of them being affordability, now energy efficiency. We don't have to know exactly what it means to be energy efficient. The architect, the planner, they will take care of it. So as long as we meet the point system, so having a high efficiency boiler or having extra insulation, different types of engineered windows, that will get you to the points that you'll need to hit that 100 points.
It's also worth noting that we're working with experts in these fields, builders, engineers, architects who specialize in exactly this, and they specialize in this in that market. So for instance, real example, there's certain markets in Alberta, certain municipalities that'll offer you grants if you're doing energy efficient upgrades like putting geothermal heating, right? We don't need to know that. We're not building code experts, we don't pretend to be. We have architects, engineers, consultants who specialize in that, and they'll know to go get that grant and make it geothermal, for instance. Same goes for the accessibility requirements. Again, we don't need to know the building code on what isn't accessible, but the premise, the essence of what we're saying is the same. We need to have some elements of accessibility, wider hallways, hand railings, certain lighting for people who might have visual impairments, right? All of these things are spec'd out, and then we have a consultant who signs off on them saying, this build has been built in accordance with X, Y, and Z.
So just to recap, the MLI Select key benefits, it's extended amortization. 50-year amortization is unheard of in Canada. Up to 95% loan-to-cost financing and below prime interest rates. So currently, interest rates for residential mortgages around 4.3, and that's the best rate I've seen personally. But we're seeing anywhere from 3.5 to 3.8 approval for an MLI Select program. And best of all, it's a 10-year term, so you're locked in that rate for 10 years.
You're basically at the 5-year bond yield plus 50 basis points right now, which forget commercial, for any loan is unheard of. If you're under 4% locking in for 10 years and you're cash flow positive, that's very rare. So we're very cautious when we're throwing around this word, but this basically means that you are guaranteed to have a cash flow positive building. And why can we guarantee that? How are we so confident that we can guarantee it? Well, it's because of the next slide right here. We can guarantee that these buildings are cash flow positive because all of our financials, when we're putting together these pro formas, they're independently verified by the CMHC. The CMHC is not making money here. They reject 80% of their applications, okay? We have, thanks to our partnerships with our friends over at Meta Realty, we're running 100% approval rate right now.
We filter out 90% of what is provided by the builders because we have such experience dealing with CMHC approvals.
So when they're reviewing our pro formas, they're not only going to make sure that our rents are true and accurate, right? We're not charging $10,000 for a one bedroom, right? They're going to make sure it's actually in line with market. Then when they look at our expenses, they're going to make sure that our expenses are true and accurate, but not only are they going to make sure that they're true and accurate, they're actually going to inflate your expenses because they want to make absolutely certain that if they're going to finance 95% of the building and they're going to insure it, they're going to insure that loan, you better believe they're going to triple check and triple check their work. So I'll give you a real example. On some of our pro formas, the vacancy rate in Edmonton right now is sitting about 1.5%, 1.9%, depending where you look. We use a 5% vacancy allowance, more than double. And these buildings are still cash flow positive.
So CMHC doesn't have a financial interest in any of us. Really, it's their job is to protect Canadians and provide more housing. They're not in the business of bailing builders out. So if they put a certificate of insurance, they're checking through years and years of data to make sure that the rent comps are in line, to make sure the build costs are in line, and they do their due diligence on the builder as well before they provide that certificate of insurance.
And this last point is really important. Is everybody familiar with the DSCR, debt service coverage ratio? Very, very simple. You take your net income, right? The income after my expenses, but before your mortgage, and you divide it by your debt service. Net income divided by the cost of your mortgage, plainly. A ratio of 1 or 100% means the property is breaking even. You're not making money, you're not losing money. The CMHC needs a minimum debt service coverage ratio of 110%. Most of the transactions, most of the deals that we're putting together, on average, have a minimum debt service ratio of, I would say, about 115%. On the higher end, we're sitting at about 140. The average, I would say, you're at about 125%. So we have a huge buffer where these properties are still cash flowing with inflated expenses.
The reason is CMHC doesn't want these builders to go bankrupt because they're not in the business of bailing people out. Why not leverage government-backed financing to maximize your investment? Why swim upstream when you can go and profit by working with the current?
So we don't like knocking on other investments. We've been in this industry a very long time. We've sold the pre-construction condos. We bought the pre-construction condos. We've sold the single-family homes. We actually both just bought a pre-con house out in Brooklyn. So we don't mean to knock on other investments, but when you look at the facts are very simple here. For the same price that I can buy a $500,000 condo downtown Toronto, 20% down and put in $100,000, and that $500,000 condo is going to bleed me money every month. For that same $100,000, I can buy a $2 million building with 5% down that cash flows $30,000 a year after all my expenses. That's the power of the CMHC MLI Select program.
Can you repeat that?
Yeah. So I can buy a $2 million building. Purchase price is $2 million. Assuming I score all 100 points, you can buy it with as little as 5% down. So I can buy it with $100,000 down. That's my down payment. That same building, and we'll show you a pro forma that actually supports these figures that I'm sharing with you. That same building can generate about $30,000 a year in net income after all your expenses, including your debt service. So on $100,000, that's a 30% return year over year, a 30% cash on cash return. That same $100,000 that I bought a $2 million building with is the same down payment that I need to buy a $500,000 condo in Toronto with 20% down. Yeah. And that condo is going to bleed you a couple $100 at minimum every month, right? That's the point we're trying to make here.
The whole premise of this program is that if we buy an apartment building with just 5% down, we buy a $2 million asset, the asset itself will generate enough revenue to cover the mortgage, cover the property management, cover the reserve fund, and keep it afloat without you putting in additional money. Whereas if you buy a condominium, you have to pay your property taxes, the maintenance, and most likely your rent will not cover the mortgage or break even, but you have that ancillary fees on top of it.
If you remember that debt service coverage ratio, that's a very, very important ratio. So any condo you're going to buy is always going to have a negative ratio, right? Our prices are so expensive. Sure, we have great appreciation in Toronto, right? And that's a play that people might want to make. But the debt service coverage ratio here, if you're buying a building with 130% DSCR, that means the building generates 1.3 times the income needed to service its debt obligations. There's a big buffer there, right? Go ahead, Daniel.
Yeah, so the MLI Select, it's a turnkey investment. I don't need to be a professional engineer to know all of this, the process of building something, but everything is handled for the buyer, from land acquisition to entitlements, site plan design, CMHC application, construction management, lease up, stabilization, and ongoing property management. It's all bundled up. So we have all the contacts set up and ready to go. Being a builder is not easy. It's very, very difficult because you have to do all those things yourself. But being a landlord is relatively easy. All you have to do is communicate with your property manager, fix things when things come up, and that's it.
Just to put in perspective the value of a turnkey offering. So the CMHC financing has been around for a very long time. You might have only heard about it in the last month, but that's only because it just recently became available to the retail investor like you and I because of what we're putting together here. But to put this in perspective, I've got a client of mine who builds purpose-built apartment buildings. There's one project in particular he was telling me about. I don't know what the actual cost to build is. Let's say it's a $20 million bill. What I do know is he paid a mortgage broker $70,000 to prep and submit his CMHC financing application in order to get these incredibly favorable construction financing terms. So it's been around for a very long time, but it's been kind of gate-kept to the builders and the people who have the big building machines and the massive amounts of money who are able to facilitate such a sophisticated and difficult process and expensive process. So what Daniel and I did, thanks to our partners over at Meta Realty, we saw this gap in the market where there's this incredibly attractive financing product, but it's only reserved for the 1% who have the money to put this together. So we're partnering with friends, family, colleagues who have partnerships with builders out in Alberta, with the lenders, with the mortgage brokers who are dealing directly with the CMHC, with the architects, the consultants who specialize in energy efficient and accessible housing. And we're putting together this turnkey offering to make it accessible to the average person like you and I.
So let's talk investor requirements. Not everybody can get in on this because of the high net worth requirement of this. It's relatively high because in order to buy a $2 million building, you need to have at least $500K in terms of net worth. And the cash needed, you need 5% cash, liquidity, another 5%, so 10% in cash, and then net worth of 25%. So this is a higher barrier to entry than a standard condo buyer.
Now, when we say 10% in cash, I mean a variety of things, right? The 5% contingency or 5% liquidity could also mean you have access to a line of credit, right? The CMHC basically wants to know that if they're going to give you this loan for 95% of the building's value, you're not scraping the bottom of the barrel with your last dime to do it. Because these buildings cost a lot of money to operate and maintain, right? You got to change the roof, you got to change the windows. These are not cheap buildings to operate. They want to make sure that people who are applying for this not only have the net worth and the liquidity, but they can manage a building of this magnitude.
There is a beautiful part to this though. Your T4s can show $10 and that's okay. Because CMHC values the asset in itself, not by the personal guarantee. So there's no personal guarantee in terms of personal income, but you'll need to show that net worth.
Now, again, when Daniel mentioned limited recourse, there may very well be a personal guarantee to a limited amount for the corp that owns the building. But the point we're trying to make here is they do not check your personal income. The loan is tied to the property more so than to the person. So they're going to check, again, your net worth. They'll check your credit as well, but we've seen people get approved in the 500s because they have massive amounts of net worth and liquidity. So your credit's not nearly as important as it is when you're getting a traditional residential loan. Your income isn't considered like it is when you're getting a traditional loan. And very, very important here, if you go get a traditional residential loan, assuming it's with a different lender, they will not see this on your credit report. Because again, the loan is tied to the building, not to the person. So I mentioned we purchased a pre-construction home that takes occupancy in 2027. If I had a $2 million building where 95% of it is financed, I've got a mortgage for $1.95 million. It's going to be near impossible with the TDS and GDS ratios to go get a residential loan if it were to show up. And that's the beauty of this product. It does not show if you're using two different lenders. So to summarize, you've got a loan that is backed by the federal government of Canada. When you submit your application, or the mortgage broker submits it on your behalf, a lot of paperwork involved. Our job's to give the mortgage broker whatever he wants. He puts the application together. And once we get that certificate of insurance from the CMHC, that's a golden ticket. You walk into any bank, any lender with a certificate of insurance from the federal government of Canada, they will be salivating to give us a loan. And that's why this program is so valuable, because of that certificate of insurance. We can get up to 95% financing, and I want to stress it's up to 95%. There are some properties, some projects that require 10% down, but in that ballpark of 5 to 10%. 50-year amortizations, you can lock in your rate for 10 years. Below prime interest rates, again, traditional financing, commercial, you're paying close to or above 6%. Here you're below 4%. The huge piece here, again, is that the CMHC independently verifies our pro forma. So this isn't trust me, bro, the numbers make sense. They're going to do their own homework, and they have the data. They have property tax bills. They have utility bills. They have the data to confirm that these are true and accurate. And then lastly, fixed price construction. If the build, because remember, these are pre-construction. The only way to score all 100 points is by building new in order to have those three elements. So fixed price construction, meaning if the builder tells us the build is going to be $1 million, that's a fixed cost. Any cost overruns are the responsibility of the builder.
The builder will make their money in terms of with the land lift and from the fixed construction. Of course, they take a margin, But if they have any cost overruns, we're protected in that essence.
So it's once you look at the data, not just about the market out west, but about CMHC MLI Select, once you look under the hood, it seems pretty obvious that you can't lose. And again, I want to stress that this has been around for a very long time. All the old apartment buildings that you see in Toronto, these were all financed with CMHC products. Again, this is just the first time it's being offered to the retail investor like you and I, but it gets a lot better. Anybody ever heard of pari passu, the term? It's a Latin term. It means equal footing. Pari passu lending, in the context of CMHC, means that you can get a second mortgage at the same rate as your first, and it's treated as if it's in first position. I'll dive into that a little bit deeper. So what we're seeing right now, we're not guaranteeing this, but this is something that's happened organically for the last however many transactions we've been doing. Because the multifamily market as a whole has been appreciating, there's a lot of interest rates are on their way down, cap rates are following suit, and asset prices are rising accordingly. What we're seeing, and we have real examples of this, I'll give you one right now. We have one gentleman who purchased a 9-unit building for $2.6 million. Now, if you remember, we said you can finance up to 95% of loan to cost. The cost to build this 9-unit building, in this case, was $2.6 million. Once you're doing your application with the CMHC, they're going to want an appraisal. They're going to want what we call an as-built appraisal. An as-built appraisal assumes that the building is finished. It assumes that it's tenanted, stabilized, and occupied. That as-built appraisal, in this example, and again, we have countless more like it, came in at $3.1 million. So he bought it for $2.6 million. He's financing it at 95% of loan to cost on $2.6 million. 6 months later, the appraisal comes in at $3.1 million. And now you can go back to the lender and say, hey, I'd like to refinance using this pari passu lending and pull out 95% of the value. Loan to value is now $3.1 million. So in this example, you can pull out your initial 5% deposit in some cases and some. That's the power of pari passu lending in the context of CMHC.
Now, once that's completed, you take that $500K additional funds and you invest it into something else. And the way you can do that is because your net worth is still there, and now you have a bigger net worth to buy a new apartment building. And this is how the wealthy continue to build their wealth.
And so our plan here is to buy as many of these as we can. We've drank the Kool-Aid. We've already purchased one each independently of each other. And our plan is, again, because the multifamily market is appreciating the way it is, because there's so much demand in this market, again, it's no guarantee that these properties are always going to appreciate higher. But in the event that it does, you can refinance, pull all your equity out, and go buy another one. How else can you buy an apartment building with as little as 5% down? And there's a reason that these are only, this pari passu lending, it's only being offered to these CMHC loans because the federal government of Canada is vetting these deals, and they're insuring them. So why wouldn't a lender feel comfortable giving you that second mortgage in first position? So I've said it once, and I will continue to say it. CMHC MLI Select is very much the world's best kept secret. It's playing the real estate game with the cheat codes on. We are going to run through a pro forma, but if you guys have any questions, now would be the time.
So unfortunately, we don't have a gap here in GTA, right?
No, there's no good opportunity in the GTA. Yeah. It only makes sense in Alberta where there's no development costs. Very easy to rent out because of the low vacancy rates.
The big factor to keep in mind is the affordable rent component. Because most of the points that we're scoring on this 100-point system, especially in Alberta, comes from the affordable component. The CMHC changed it. You used to be able to get more points from the energy efficiency side of things. They reduced those points. So rather than doing this in Toronto and making a building incredibly energy efficient, you can't score all 100 points. So this is also offered in the resale market. In the resale market, you can buy, I just sold a 6-unit building in London. It's probably a 100-year-old building, renovated, has some energy efficient upgrades. It's got great loan terms. We got a 40-year AM. We're paying about 4.5% interest, 15% down. It's still significantly better than a traditional commercial loan. But the cream of the crop really is the MLI Select because you're building new and you could score more points. And again, the reason it's not really as profitable in Toronto is because if I have to offer a certain portion of my building at or below the benchmark rate, if the benchmark rate in Ontario is in the 1200s, now you are offering it to low-income earners. Right? Now you're well below market rents. Doesn't make sense.
We only need to build 30% of affordable homes. majority of it is regular rents. It's market rents. So for my purchase, I bought 3 houses. It's a sixplex, 3 houses with basements. And the basements are affordable component, and the main floor and the second floor, they'll be standard rents. And that's how we keep the profitability high.
And how we track all the construction from here?
We're not doing it, right? We have partners out west we've partnered with some of the biggest and most reputable builders out west. So
Your homes,
this
sir.
right here, this is my purchase here. This is exactly what I bought. I bought a 7-unit building. It's built by Sterling Homes, if anyone's ever heard of them. They've been around 70 years. They're very much the green park of Edmonton, or of Alberta as a whole. And we'll run through these exact numbers. This was my purchase. So my purchase price, top left-hand corner, is $2,050,000. Now the deposit for this one was actually 10%, but it shows 5% because I'm going to get 5% back on closing. So sometimes the builder, the lender might require 10% up front, you get 5 back on closing. So that was my case here. So what's also great about these aren't, if you're buying, let's say, 15 units or less for the most part, they're not going to be apartment buildings like you would imagine them. In this case, this is 3 detached homes and a garden suite on one title. Now, the reason I would prefer that is when you look at a purpose-built apartment building, you've got a lot of common areas. Common areas cost you a lot of money, and they don't generate any money, right? Hallways, elevators, these are expensive areas to maintain, but they don't actually generate any rental income. When you have 3 houses, for instance, on one title, still qualifies with CMHC because it's one title, but more importantly, every inch of my square footage is rentable, right? It's also a heck of a lot cheaper to fix a shingled pitch roof than it is to replace a flat roof, right? Once you get into those buildings, costs can be a lot bigger, a lot greater, and unless you're building the 20, 30, 100-unit buildings, more often than not, it's more profitable to do this.
You'll see the back-to-back townhouses that have 3 bedrooms upstairs, 1-bedroom studios in the main floor, but we're getting a lot more inventory from reputable builders like Daytona, major builder around 30 years.
Yep.
How long does it take to build before we can start seeing that income from these?
So we've seen anywhere from 8 to 12-month turnaround times, very, very quick. So this isn't your standard 3-4 year pre-construction project. Some as long as 18 months.
Because we're in the same market, we're transacting the same market.
Right? That would be something to keep in mind, right? If it's a 4-year turnaround time, well, we're saying all these great things about the market right now. Vacancy rates have gone from 7% to 1%, but if your build time is 4 years, market can change 4 years from now, right? We're turning around in a year or so.
Is this a new build?
This is a new build. This is not built yet.
They're all new.
They're all new build. This will be built in about 12. This will be built, tenanted. I'll have a property management company in about 12 months.
And then not all your units are affordable?
No. So here, see that my first one, 2-bed basement for $1,550. Second one, a 4-bedroom house is offered for $2,500. There's 3 of them. My affordable unit is the 2-bed basement that says afford. And if you notice, the 2-bed basement that doesn't say afford is the same rental rate because $1,550 is the market rent. But if you remember, the affordable rent in Edmonton is $1,650 or $1,640 rather. It's still below the market. So I'm scoring free points here. I'm scoring free points on the system without sacrificing profitability. That's why this is so profitable out west.
And so the point system is for MLI approval. The point system is for them to approve your loan.
Not only approval, but it also dictate what loan terms you can get. If I'm under 100 points, I can't get the 95.5. Maybe you can get 85.15.
And
Right.
the 50 years is what you need for 100 points.
We really only want 100 points.
Like I mentioned, not all of it needs to be affordable. What I have is just 3 units in the basement that are affordable, 3 main floor and second floor units. They're all standard rents. Only a small portion of it needs to be affordable because the government knows we can't build it all affordable. If we build it all affordable, it's not going to float itself. It's going to be a failed project. So that's why they allow us to have small portion.
So let's run through this from A to Z. So here are my rents per unit. You see total number of units is 7. My total annual gross rents is about $161,000 a year. Okay, that's the gross rent before any expenses. Now let's look at our expenses. And again, remember, CMHC is independently verifying. They're not just trusting us. So property taxes,
Actual numbers.
actual figures, right? The CMHC has access to municipalities' real data, right? Real property assessments. So actual figures for property taxes. Insurance, we've done a number of deals. We know what insurance rates are for a 7-unit building. Utilities are zero because the tenants are obviously paying their own utilities. Repairs and maintenance. So now the following expenses that I'll run off here, these are all expressed as a percentage of my gross income. Okay? So repairs and maintenance, ballpark, I believe I'm at just over 1.5%. Management and salaries. Property management can range anywhere from 6 to 10%. That's in Toronto. Out west, you're probably sitting around the 6% range, a little bit cheaper. So that's what our management and salary is. And again, these are all being deducted from my gross income of $161,000. Other costs, again, the CMHC just wants to see additional deductions, right? Replacement reserves. This is an expensive building to maintain. In 25 years, I'm going to have to replace the roof. I'm going to have to change the windows, right? These savings accounts, so to speak, repairs and maintenance, other costs, replacement reserves, these are basically savings buffers that are going to allow me to do those things.
Are you partnered with anyone on this property?
I'm partnered with my brother-in-law, actually. And funny story, my brother-in-law has his MBA. He has his CPA. He's married to my sister. He's got 3 kids, and he's the most risk-averse person in the world. We have poked every possible hole that we can try to poke in this thing.
Belgium, for that, he is the most.
We have tried to poke every hole that is humanly possible. We can't make it not make sense. Really, that's the honest answer.
We put our money where our mouth is. Like I bought with Vicky Wong and Jake, who actually brought this program here, and they're investing with me on this project.
Those are the people who have basically pioneered
Pre-construction
in Toronto. They were selling pre-con in Toronto and it was $400 or $500 a foot. And now thanks to our partnership with them, we're able to facilitate this, which is very much in its kind of pioneer phase, right? It hasn't always been available to us, right? Anyone can do this. You don't need a special license to go get a CMHC loan. Yeah. But putting it together from A to Z, that's where it gets sophisticated. Yes, sir.
So how much money did you invest up front for this to begin? Did you have to acquire the land yourself?
Nope.
That's all packaged. Just $102,000.
And you
This example actually was 10%, so it was 205. But yes, so I bought, just like, okay, let's use an example here. Everyone knows Tridel, great builder, household name, arguably one of the best builders in our city. They've built half of downtown. If you want to buy a shiny new condo from Tridel at the Well, for instance, one of their latest developments, you walk into their office, they've already bought the land. They've already figured out who's doing the zoning, who's doing the forming, who's doing the framing. They've figured it all out. You're going in, you're signing the contract, and you're buying a $600,000 condo that's going to be built in 4 years. You don't even think about it. You fall asleep. 4 years later, you wake up, you've got your shiny new condo, right? We're doing the exact same thing. We've got builders who've already found the land. They already got it zoned, entitled, site plan approved. We've got engineers, consultants, and architects who specialize in those 3 elements of accessibility, energy efficiency, and affordable, right? Yeah. They're going to configure the building perfectly. We just sign on the dotted line, and 12 months later, I get a shiny new apartment building with a property management company that's going to get it tenanted.
That's why we call it a turnkey solution. Basically, you put your initial investment and wait for it to complete. Once it's done completion, you start leasing it up and start collecting your checks.
Now, again, keep in mind, the reason the CMHC has such strict requirements around who can do this in terms of net worth and liquidity is they're not cheap buildings to carry, right? When this is built, it might take me a month or 2 to find a tenant. I'm going to have to carry that mortgage for 2 months. It's not a cheap mortgage. I mean, sure, it's 3.75% interest, locked in for 10 years over on a 50-year AM.
So I have questions. Like you said, they don't look at your income; they look at your assets. And
correct.
So that let's say you have 400,000, 500,000 in your bank account.
That counts.
That counts.
That's money. That's cash, liquid
stock.
Cash.
Yeah, cash, stocks. You own a home worth $1 million and you have a $500,000 mortgage. That's $500,000 of equity, of net worth.
And your down payment also counts towards that net worth. Yeah.
Yeah. So again, in this example, if you see my vacancy and bad debt, it's 5%. Vacancy rate Edmonton is, call it 1.9% right now.
CMHC likes it at 4 points. So we're actually being very conservative here.
Even with all of these additional expenses, even with all of these buffers and savings accounts, after I deduct everything, my net income is $119,000 a year. After I pay my mortgage, my debt service, I'm left with $32,000, call it $33,000 a year. That's my cash flow after all my expenses, including my debt service. Now, if you remember, I put 10% down, but I get 5% back. So on my $102,000 investment, that's a 33% return. Cash on cash. We haven't even talked about appreciation. We haven't talked about mortgage pay down. That's just your cash on cash return.
This is a little bit of a higher DSCR. Average, you'll see 125 to 130.
So to answer your question from earlier, for the same down payment that I'm buying a $500,000 condo, I can buy a building that can generate this.
At which point do you know, so you put the money down when you're approved, or
When you're signing the contract,
you submit your application and
Yes.
if it gets declined, then
So here's the process. So just like a normal pre-con, you generally put a down payment on signing, depending on the builder, $3,000 to $10,000 on signing. It's a fully refundable deposit because then you have a 7-day cooling off period. Just like a normal pre-con, that's the time that you get your agreement reviewed by a lawyer. Now, because the CMHC application, A, it takes a very long time, and B, the certificate of insurance is only good for 6 months. So the mortgage broker doesn't submit your application right away. You submit it much later. So what we like to do is during your cooling off period, to answer your question of what if you don't get approved, we're currently working with mortgage brokers who specialize in exactly this. One gentleman in particular, he submitted over $2 billion with a B. He submitted over $2 billion of CMHC loans, and he has a 100% approval rate. It's not because he's some magician. It's not because he's bribing people. It's because he knows exactly what they're looking for. And if he doesn't see that in your application, whether it be your net worth, your liquidity, or whether it be the property pro forma, he's not even going to submit it. So if you remember, the CMHC needs a minimum of 110% debt service ratio. This is much higher than the average deal. I would say the average is about 125%, but you have a huge buffer there. So during your 7-day cooling off period is when we suggest people get all of their documents in order, your net worth, your financial statements, your stock holdings, your mortgage statements, your property tax bills. Get everything that the mortgage broker needs. Let him review your application along with the pro forma for whatever you purchased. And in that time, he'll give you the peace of mind whether or not he thinks you'll get the approval.
the projects that we bring to you will have approval, 100% approval based on the numbers. So where people get denied for approval is because they haven't shown their true net worth. So net worth requirement is very, very important. On the bill side, we reject 90% of all sites, and then CMHC also reviews this independently. Our mortgage broker reviews it independently. So there's layers and layers of checking in order for this site to be approved.
If we're bringing you a pro forma, it's already gone through 3-4 layers of checks. The bigger concern here is you as an applicant. So big things to be aware of. If you haven't done your taxes, that's a problem. See, the CMHC does not want to insure almost 100% of a building to someone who doesn't pay their taxes, right? If you have any lawsuits against you, that's a problem, right? If your credit score is in the 500s, believe it or not a problem. Not a problem. If you can fit everything else.
Yes.
Right? The CMHC wants to know they're giving these loans to a responsible, respectable adult who can manage this. They're even going to ask you for a little bit of a background. You got to talk about yourself a little bit. I've been in X industry for X amount of years. I've built this business. I've done this. I'm a responsible adult that can manage a $2 million building.
On the building side, we have professionals that's gone through numerous buildings before, and they'll continue to the same building standards to meet the CMHC MLI Select requirements.
Any other questions at all? I know there's a lot of information here. The reason we want people so well informed and well educated is because these deals are moving very, very quickly. So to put it in perspective, we're in a group with about 1,000 other real estate agents.
It started at 4.
It started at about 300-400.
Oh.
We're up to 1,000 now over the last 3 months, maybe.
Yes.
When a deal comes available, pro forma like this is put in that group, and our partners over at Meta Realty say basically, whoever brings us a photo ID and a bank draft first gets the deal.
It's never been packaged this way before. It was always so difficult to jump through hoops, get the land, and go through all the entitlements, the site plans. It's meant for builders, but we made it so easy for the average investor to get into this. And that's why it's been such a buzz in the real estate industry recent days.